Are you tired of the higher interest rates in today's market? What if I told you there was a way to purchase your dream home with lower interest rates than banks are willing to give you today? Stay tuned to find out how. Hi, I'm Chris Kaiser, your local real estate expert in Hampton Roads, Virginia. As you probably already know, a VA mortgage is a great option for those who have served, and there are so many aspects of them that are amazing. In my previous video, we talked about 6 things you probably didn't know about VA loans. Today we're talking about a lesser known but incredibly powerful aspect of VA loans: mortgage assumptions. Before we jump into it, let's talk about interest rates. While interest rates are higher than they have been since about 2008, they are right at about the historical average. They reached a peak of almost 19% in 1981 and slowly drifted down over the next 3 decades to the historic lows that we saw in 2020 and 2021. With interest rates as of this recording hovering around 7%, it can be tempting to explore alternative options to traditional financing, and a mortgage assumption can allow you to do just that. So how do mortgage assumptions work? I'm glad you asked. The process varies depending on the lender and whether or not it's being serviced by a third-party servicer, but VA loans are generally assumable by anyone who qualifies. However, if a non-veteran assumes a mortgage, the original borrower's entitlement isn't restored unless the mortgage is paid off or refinanced. This can make things difficult for the veteran who sells a home to a non-VA qualified buyer, because their entitlement is still reduced by the amount of the original loan. It can also cause problems because if the new buyer defaults, the original borrower's entitlement is impacted permanently unless they pay back the VA for the loss. Now that we've gotten the scary part out of the way, let's talk about the amazing part. So when a VA buyer assumes a mortgage, the original owner gets their entitlement back, and likely sold for more than they would have to a buyer who had to get a new mortgage. And that's pretty awesome. Now, as a buyer, assuming a mortgage allows you to buy a home for more than you would have with a new loan, because your debt to income ratio will be lower because of the lower interest rate on the existing mortgage. And that's awesome too. Now, let's talk about the elephant in the room. You're probably saying, Chris, what about the difference between purchase price and the existing loan amount? When you assume a mortgage, you will have to bring the difference between the purchase price and the existing loan amount to closing. Sometimes that can be a lot, and financing this balance can be a challenge unless the existing lender is willing to extend a second mortgage. But for those with substantial savings, a mortgage assumption can save thousands in interest payments over the life of the loan. It also reduces the funding fee. See, first-time buyers can pay up to a 2.15% funding fee, while those who have previously used their entitlement can pay up to 3.3%. But for an assumption, the fee is only 0.5%. So now that we've gotten through all of that, how do you actually go about doing an assumption? It works like pretty much any other loan process. You'll have to fill out paperwork with the lender, you'll have to do a loan application, there's some VA forms you have to fill out. The lender will also do all the underwriting, just like on a normal mortgage. And after all of that, you close on the property like you normally would. There is one caveat. A loan assumption normally takes 60, 90, or 120 days to complete. So it's not going to be a quick process, but there is something you can do to make it go as smoothly and quickly as possible. The key to a successful mortgage assumption is communication. Constant, persistent, almost naggingly continuous communication. Like when a toddler wants something and they never give up until they get it or get put in timeout. So, if you're looking to purchase a home with a lower interest rate than you can get today, consider a VA mortgage assumption. It could be the key to unlocking significant savings. Other loan types can also be assumable, so make sure your agent asks the seller if their mortgage is assumable. I hope you got some good information out of this video. Please like this video and subscribe to my channel to stay on top of future videos. Also check out some of my other videos where I showcase the amazing lifestyle and culture here in Hampton Roads. And until next time, thanks for watching.